Okay, I'll just make one last call for any final responses in the pre-forum poll. Please let us know where you stand on Ballot Measure One. Okay, I'm ending the pre-forum poll, and I'm going to go ahead and share those results now. So the audience thus far is responding 18% in favor of Ballot Measure One, 68% opposed to Ballot Measure One, and 15% unsure. So that's where we stand at the beginning of this event. First, let me welcome you to today's program. My name is Juanetta Ayers. I'm the Executive Director for Commonwealth North. For more than 40 years, Commonwealth North has served as a nonpartisan forum to illuminate Alaska's most critical issues. Through in-depth study programs and programs such as today's forum, Commonwealth North provides opportunities for Alaskans to learn about issues and engage with elected officials and community and thought leaders. Our program today, pardon me, just one second. I'm going to go ahead and get started. We are expecting our board president, Terry Smith, but a few housekeeping rules as we do get started. Again, we will be taking audience questions for a portion of today's program. And that's after opening statements, rebuttals, and the questions between the debaters. We will have an open session for audience questions and answers. You can submit your questions through the Zoom chat window, or you can text them to this number. So please take note, 907-230-2284. Again, that's 907-230-2284. And as a reminder to all of our participants, please mute your microphones and cameras, and we will preserve bandwidth and ensure that everybody has a good transmission during the program. All right, well, I'm going to just press on because I want to respect everybody's time. So we're pleased to welcome today two experts to debate a critical ballot measure that Alaskans will consider on November 3rd. If passed, Ballot Measure One would make significant changes in the structure of the state's oil and gas taxes, and it would impact on how our legislature approaches meeting the state's fiscal challenges. One moment, please. Sorry. All right, so the measure reads in part, an act changing the oil and gas production tax for certain fields, units, and non-unitized reservoirs on the North Slope. This act would change the oil and gas production tax for areas of the North Slope where a company produces more than 40,000 barrels of oil per day in prior years and more than 400 million barrels total. So our debaters today are Roger Marks of Roger Marks Economics, representing speaking in opposition to the measure, and Robin Brena of Brena, Bell and Walker, speaking in favor of the measure. So again, we've mentioned that you can submit your questions through the Zoom chat, and we've taken a poll to take the temperature of our audience before we get started. The flow of today's program will work as follows. Both Robin and Roger will be given a 5-minute opening statement. Then at the conclusion of those statements, we will hear rebuttals from each of our speakers. At the conclusion of the rebuttals, we will have a round of 2 questions between the parties, a short question of no more than 30 seconds, followed by a 2-minute response from the opposing party or the opposite party. Following the questions between the parties, we will have audience Q&A. And then following that, we will have closing statements from our 2 speakers. At the conclusion of all of that, we will have a final poll to see how today's forum may have affected your opinions about Ballot Measure One. So before we move off to the program, I'd like to thank Commonwealth North members who are online with us today. Now more than ever, your membership and the work that you do to educate Alaskans, including policy leaders, about Alaska's policy challenges is more important than ever. So I'd like to invite those that are not currently members to consider joining Commonwealth North and support our mission to educate Alaskans and illuminate our state's most critical issues. Now with that, we're going to spin the wheel to determine who goes first in today's opening statement. So let me, sorry, one moment. Let me share my screen. So what we have here is a wheel with the names of our speakers, Roger and Robin, and I'll spin it now. There's 10 opportunities for each name here, so we'll see who's going to go first. Okay, Robin is up first. So with that, I will invite Robin to step forward.
So let me find a way to share my screen, if I may.
All right, you're going to want to turn on your camera first.
Okay.
There you go.
Right.
Yep. And now share your screen.
Can people see the screen okay?
Yep.
Well, first, sounds like it's going to be a tough house for me today. So I just wanted to thank you for the opportunity and thank you for continuing to listen to the conversation about Ballot Measure One. The situation is relatively simple. Alaska's broke. And since Senate Bill 21, we've blown through $18 billion in savings. We've cut our dividends by 1/3. We've cut essential government services, and we've gotten absolutely nothing for all the sacrifices we've made. So the reason that Alaska's broke isn't what you might think it will be. But first, let me show you what's happened to the production taxes. The reason Alaska's broke is because there's been a complete collapse of our production tax system under Senate Bill 21. So the first screen that you see there is production taxes before credits, before and after Senate Bill 21. Senate Bill 21 is a red line in the middle. And 5 years before, we got $21 billion or $4.2 billion a year. 5 years after, we got $2 billion, which is $400 million a year. We went down to 8% of what our production taxes used to be before Senate Bill 21. If you take a look at this same situation, taking into consideration the production credits, because while we've collected $2 billion in production taxes from them, we have paid or owe them $2.1 billion in cashable credits. We actually paid them more than they paid and owed them more than they paid us since Senate Bill 21. But here is what happens if you take into consideration the credits as well. You can see that 3 of the 5 years since have been absolutely collapsed. The first thing when I point this out to people is they say, well, the price of oil. Well, the price of oil changed between these 2 5-year periods 35%. But the revenues went from 4.2 billion down to 2 billion. It went down to 8%. So price of oil doesn't explain it. The main thing that explains it is massive corporate welfare through the form of $8 per barrel credits for each barrel of oil produced. But I want to show you here on this slide, when the price of oil was the same, we used to get about 12 bucks a barrel out of our barrel when the price of oil was in the same range, and now we get about 2. We get a quarter to a sixth as much as we used to get as a result of Senate Bill 21. If Senate Bill 21 had been in effect the last 5 years, you can see the red numbers after credits, and then you can see if Ballot Measure One would have been in effect. And on average, Ballot Measure One would produce $1.1 billion over the last 5 years under all the prices and oil circumstances. Now, I gotta tell you that that if you take a look at our budget, how broke we are in the budget deficit, the major issue that you see when you look at the numbers is we used to have revenue from production taxes and now we don't. And so what do you do about that? Well, the obvious thing to do is to raise them to a fair level. So how do you determine what a fair level is? Ballot Measure One will bring in, on average, lower production taxes than we have collected for the last 30 years. It doesn't even get back up to the average. We are getting, between combined royalties and production taxes, we're getting 12.5% of gross now. We have averaged 27% of gross for the 30 years before Senate Bill 21. When Governor Palin was in, we averaged 38% of gross. Other states average between 29 and 35% of gross. We are getting the lowest that we've ever gotten for our oil. We're getting less for our oil than when Bill Allen was bribing legislators to lower production tax bills. We are getting less for our oil than ever. Senate Bill 21 is the largest resource giveaway in the history of Alaska. And if you compare it to our sister states, we're getting about a third. And if you compare it with other countries, we're getting about a third. So we just can't afford to give away our oil anymore. And so Ballot Measure One represents a reasonable thing, doesn't even take us back to our average, and it solves a lot of the problems and by simply eliminating some of the massive corporate welfare that we frankly just can't afford to continue to provide. So at the end of the day, it's not, I'm sorry?
Time.
Oh, okay, then I'll just wind up my thought. Ballot Measure One's going to keep 1.1 billion barrels in Alaska. That's the economic equivalent of 11,000 jobs for $100,000 a year. And it's not going to hurt the industry. It's not even going to take them back to the average taxes, and it only applies to the biggest, most profitable fields. It's what we need to do.
All right, thank you. All right, Roger?
Hey, good afternoon. I am not being paid by anyone to work on this, and I have no financial ties to the oil industry. As a citizen and someone who did oil tax analysis for 35 years in the state with the Department of Revenue and the legislature, I'm concerned that the initiative is a product of extremism and several misleading inaccuracies. It's a huge tax increase, 150 to 350%, depending on price. It's a doubling to quadrupling. That's extreme. How might this play itself out? Producers will have less cash, projects here will be less viable, producers have plenty of opportunities outside Alaska, and those outside projects become more profitable. In Alaska, there was a 1989 oil tax change. Just like this, it targeted the big fields for high tax rates, and immediately investment switched from the high tax fields to the low tax fields. Production dropped, the tax became anemic, and the only difference between then and now is now they can switch investments to federal acreage where the state will get no royalties. There'd be incentives to keep production low to circumvent the terms of the tax. At Milne Point, there are planned developments to put it over the threshold where the new tax would apply. If this passes, you can forget about that. They tell you the initiative only applies to the big 3 existing fields. What they don't tell you is that these fields exist in several pools. It would nail several existing expensive pools of heavy oil going into these older units. It would nail several new pools planned, particularly at Alpine, going into the older unit, Greater Moose's Tooth 2, Fjord West and Narwhal, that could total 70,000 barrels a day. During ACE's tax regime between 2007 and 13, there were very high tax rates. There were high prices. The producers made profits here, but they were just making much more everywhere else. Investment here was a fraction of what occurred in other places. Production dropped 200,000 barrels in that time. Producers didn't leave the state. They didn't make an announcement. Just Alaska is one of the few places on earth where production dropped when prices exceed $100 a barrel. And I don't know how many people realize this, but Ballot Measure One has higher tax rates than ACES at prices up to $120 a barrel. No one thought ACES was not high enough. That is extremism. The way economists compare competitiveness, they look at the percentage of pre-tax profits paid to government. Department of Revenue data over the last 5 years, the producers paid 74%. The comparable figure in the lower 48 is 64%. How does the Fair Share Act say you can get away with this, have these higher taxes and not affect investment? It comes down to a very misleading representation about North Slope profitability that gets mixed up in how oil and gas accounting works. They're comparing the per unit profits of operations in Alaska that are 100% oil with the blended per unit profits everywhere else where operations are 50-50 oil and natural gas is 1/5 the value of oil on a BTU basis. They're not comparing oil and oil. The Legislative Research Agency has repeatedly warned that drawing conclusions on profitability based on reported per unit profits is problematic. And if you think about it, how could the North Slope be more profitable? Just look at transportation. It costs $10 a barrel to get oil to the US West Coast. In Texas, it takes $1 to pipe oil to the refineries there. And Alaska is a remote and hostile work environment. The international consulting firm Wood Mackenzie recently pegged Alaska's cost at $20 a barrel more than the lower 48. But the initiative's whole premise is that Alaska is so much more profitable and can pay all this extra tax and still be fine is based on not understanding basic accounting. In 2009, ConocoPhillips capital investment in Alaska equaled their profit in Alaska. Under ACES, North Slope production was declining 6% a year. Under SB 21, production has been stable. It's now making 100,000 barrels a day more than what was expected in 2020 under ACES. And with the additional barrels, the state's making more money than it would have under ACES. With prudent investment, we can sustain that or a modest decline and recover 5 billion more barrels from Prudhoe, Kuparuk, and Alpine. Or in the absence of investment, there'll be steep decline and only recover 1/3 of that. Producers won't pack up and go. There won't be a big announcement. Just decline will get steeper and steeper, just like ACES. So do Alaskans want to gamble away 3 billion barrels? And where is the analysis that this wouldn't happen? In a daily news story recently, Mr. Brena said he worked with 15 other people developing this, and they all want to be anonymous, all of them. The analysis they did roll out was just an Excel sheet that increased the tax rate from A to B and assume nothing else happens and goes, wow, look at all that extra money. Competition and costs were never mentioned. So here you have an overhaul of the tax system of the largest industry in the state without adequate vetting and without safeguards against extremism and misrepresentation. Thank you.
All right, thank you. All right, now we will go to rebuttal statements, and we will start with Mr. Brena.
Well, first, let me say that the 300% increase in the rates, the entire industry is expected to bring in 122 million next year. We used to get 4.2 billion on average. So you can play a percentage game, but when you're paying nothing, it's easy to pay more. So he brings up 300% increase. He doesn't bring up the 600% or 1,000% decrease that Senate Bill 21 put in effect. We are literally just taking back part of our fair share that we used to get. He mentions theory about investment. Now, we started giving away our oil under Senate Bill 21. The last 5 years under Senate Bill 21, we've had less investment than under ACES or in the last decade. So in fact, what's happened is we're giving away our oil for nothing. Our net production taxes are zero, and they're not investing more, they're investing less. So all that's happening is our money is leaving the state. They promised more investment, they didn't deliver. They promised more production, they didn't deliver. Production has continued to decline. He says that it did better than the decline that was expected. He picks out the one production forecast, which is the worst one the state ever made, which judges rejected. And he says, well, we beat that one. Well, before, when we were being asked to give away our oil, we were told 1 million barrels a day. Well, we're continuing to decline. Employment, we had more employment. Considerably under our prior tax regime, which was higher. So we got nothing. We gave away billions of dollars and we got nothing for it. So it's time to get something for it. In terms of his presentations of government take, they're all calculated wrong, and they're not even consistent with what ConocoPhillips tells the legislature. In terms of ACEs, ACEs outperformed Senate Bill 21. We got more investment and more jobs out of ACEs. And in terms of comparing the process, this process has required tens of thousands of communications with Alaskans, 40,000 signatures, and we get 400,000 people voting. The process under this involved 15 people working with modeling with Ken Alper, the former tax director, doing detailed modeling in all scenarios. The process for Senate Bill 21, the biggest single ticket item at issue here is the $8 credits for each barrel of production for no reason at all. And those got into our law because an hour before the vote, somebody put them into the law. They weren't modeled, they weren't vetted, they weren't discussed. They just got it put in as a political matter. So if you want to compare processes, this is the best process with regard to oil policy that's ever been in Alaska. And it's the exercise of direct democracy as it was intended to be exercised. So, and finally, the whole idea, the last thing I'll say, it sounds like my time is up. The last thing I'll say is that Alaska, these fields are profitable. This is all about Prudhoe Bay. 2 of the $3 from the Ballot Measure One come out of Prudhoe Bay, cost less than $25 a barrel to produce oil. In the $40, $45 range that we're in now, they make a killing.
All right. Thank you, sir.
At Prudhoe.
All right. And Mr. Marks, 3 minutes.
So before you let someone tell you what is or isn't fair, voters should think for themselves about what fairness means. The sponsors of the Fair Share Initiative would have you believe the state's entitled to 1/3 of gross revenues. That's clearly stated on their website. That's their standard that drives the terms of the initiative, and it is absurd. Gross revenues by definition is the oil market price less transportation costs. So if price is $60 a barrel and transportation is 10, the gross is 50. That's what's averaged under SB 21. But part of gross revenues consists of production costs. Those have averaged $25 a barrel. That's 50% of the gross. And if the state's getting 33, it doesn't leave much for the taxpayer. In the past, when costs were much lower or prices higher, getting 1/3 may have been fine, but any reference to historical percentages of gross as a standard for fair is arbitrary and meaningless. The use of fair here is a loaded term and makes no economic sense. State revenues fell after 2014 because oil prices fell. SB 21 went into effect then, about the same time oil markets began to crash. This is a net tax, and the tax base is calculated as oil price less costs. Between 2013 and 2016, the net value of oil dropped from $68 a barrel to $3. That's a 96% drop. When Mr. Brena was comparing 2009 and 2015, what he didn't tell you was that in 2015, costs were $30 a barrel higher than they were in 2009. The state petroleum corporate income tax, a completely different tax than this, but also based on prices and costs, it dropped over 100% during this period. State revenue would have dropped under any tax regime. To blame lower revenues on SB 21 is to misread history. The Ballot Measure One sponsors say the producers paid no severance tax between 2015 and 19. To get to that result, you have to combine two completely distinct ledgers. The producers quite clearly paid $2 billion in severance tax, and doesn't include another $9 billion they paid in royalties, property, and income tax. At the same time, non-producers received $2 billion in credits, and these credits have been phased out. Now, Ballot Measure One is directed at the same producers who paid the tax. The per barrel credit in SB 21 is a progressivity mechanism, but instead of increasing the tax rate as prices go up, it starts at a high 35% rate and decreases the tax rate as prices go down. It's as if your IRS tax rate was 20%, but the way they get you there is first they tax you at 35% and then give you a credit to bring it down to 20. It is removing the per barrel credit that creates the massive tax increase. The per barrel credit does not function as a credit. It's not a subsidy or a giveaway, and it shouldn't even be called a credit. All around town, I see signs that say, vote yes, stop the giveaway. Revenues fell because oil prices fell. Profitability in Alaska is lower, not higher than the lower 48. Producers here pay a higher share of profits to government than they do in the lower 48. Producers paid plenty of severance tax over the last 5 years. The per barrel credit does not function like a credit. So just what giveaway are we talking about?
All right, thank you, Mr. Marks. All right, now we'll turn to questions between the two speakers. Mr. Brena, if you could go ahead and bring up your camera and leave it up during this portion. We will start with you. If you could please pose a brief question to Mr. Marks, no more than 30 seconds, and then he'll have 2 minutes to respond.
Okay, well, there's no question Alaska's broke, Roger. We have no capital budget since Senate Bill 21 has passed. We've cut our dividends to 1/3. We've spent $18 billion of our savings. All of these are sacrifices that Alaskans have made since Senate Bill 21 passed. Now, I'm curious, we're in a situation where with zero PFD, with no PFD, that we have $1 billion deficit. What is your plan, Roger, for solving the state deficit?
Well, I guess first of all, at current prices, the initiative would only bring in about $250 million. That would make hardly a small dent in the deficit. But getting to the big picture, 40 years ago, Alaska's made some decisions that made sense back then, but don't make sense now. Back then, the state had more money that knew what to do with. It decided oil could fund 90% of the budget. There was 4 times as much oil then. The population and the budget were much lower then. It decided it could pay dividends from permanent fund earnings, and those earnings would not be needed to fund essential state services. And it decided it didn't need a broad-based tax. And at the end, and over that period, the state never diversified its economy. So the budget problems the state has is structural. The investment climate response to this will actually make things worse, not better. You might have might make a small short-term dent in the deficit. But in the long run, you're gonna hurt the biggest industry in the state. In the long run, you'll have a bigger problem than you have now.
All right, thank you. All right, Mr. Marks, you can pose a question to Mr. Brena.
I just like to post the same 2 questions I posed in my opening statement. Do Alaskans want to gamble away 3 billion barrels in lost oil due to an uncompetitive tax system? And where is the analysis that this wouldn't happen?
First, there is no gamble involved in passing Ballot Measure One because we have had higher tax rates for 30 years and we know exactly what the impact is from that, which is, but secondly, it's false that we're gambling anything on the oil industry side. But before I get to the direct answer, let me say that we're going to bring in $1.1 billion on average more. That is 11,000 jobs at $100,000 a year, plus a multiplier effect of 6 or 7. That's $6 to $7 billion of economic activity in Alaska that would otherwise not occur because that share, our share, would otherwise leave the state. It's not going to stay here. It's going to leave the state. 68% of ConocoPhillips' earnings of net income have come from Alaska, and 15% of its net investment has been in Alaska. So before you even discuss the impact of the industry, realize that by keeping $1.1 billion more in Alaska, we are massively helping this economy. Now, will there be any impact on the industry at all? And the answer is no. And now, and the reason is, first of all, that it doesn't apply two fields other than three big fields that have been paying on average higher taxes than Ballot Measure One would impose for 3 decades and still have been able to draw investment and actually create a higher level of jobs than they do today. So there is no reason to believe that there'd be any impact on investment. He talks about, they talk about the impact of fields that the Fair Share Act doesn't even apply to. The two brightest prospects are Willow and Pika. The Fair Share Act doesn't even apply to those fields. So no impact to the industry. The harvested large massive fields can sustain and have sustained for 3 decades higher taxes than Ballot Measure One would impose, and a massive, massive additional revenue for Alaska.
All right, thank you. All right, now Mr. Marks, we'll start with you. Do you have another question for Mr. Brena?
Gross revenues have 4 elements. It's what the state gets, what the feds gets, what the producers get, and the upstream production costs. As costs have risen over time and oil prices go up and down, the costs can take up anywhere from 5% to over 100% of the gross revenues. How can 1/3 of gross or any reference to historical percentage of gross possibly be a standard for fairness?
Well, first of all, Roger, you keep saying that Ballot Measure One is based on 1/3 of gross. It's one of the standards for fairness. It's the standard for fairness that Governor Hammond, that created the original deal, established. If you read his book, what he says is the deal was 1/3, 1/3, and 1/3. And a few years later, when we were getting 27%, which is over twice as much as we're getting today as a percentage of gross, he was saying that Alaska was being fleeced and robbed of hundreds of millions of dollars. So I sort of take Governor Hammond at his word that he knew what he was talking about when he said 1/3, 1/3, 1/3. He wrote it in a book. And I kind of figured that he knew what he meant a few years later when we were getting 27%, which is over twice as much as we're getting today. And he was saying we're being fleeced at 27% because it wasn't enough. But 1/3 isn't what's built in. You keep repeating that 1/3 of gross is how the Ballot Measure One works. That's not how it works. And if you'd modeled it, you'd know how it works. And all it does mostly, most of the money out of Ballot Measure One comes out of Prudhoe. Most of the money out of Prudhoe, we're talking about $2 out of $3, is eliminating of massive corporate subsidies and welfare of an $8 per barrel credit that was just thrown in the legislation an hour before the vote. So this isn't, so in terms of the standard of fairness, I think you can look at what we've historically got, 27%, we're getting less than half. I think you can look at what our sister states get, which is 3 times more than we do. I think you can look what other major oil resource owners around the world get, which is 3 times what we do. I think you can look at ConocoPhillips earnings, where they're making more than 3 times more in Alaska than they are any other place in the world. All those are standards of fairness, all of which we're well under.
All right, thank you. All right, and Mr. Brena, one final question for Mr. Marks, please.
I want to drill down and get out of the theory and into the hard facts, Roger. You know, Prudhoe Bay is where the money is. It's where the production is. Okay. Now, Prudhoe Bay in 2018 created $3.7 billion of net income after costs. The costs are publicly known. The revenues are publicly known. They made $3.7 billion. Now, we gave them, when they made $3.7 billion, which, by the way, is a margin of $40 a barrel. The price of oil was $63.61. Their margin was $40 a barrel. So we gave them $742 million, $750 million of credits when they were making $40 a barrel. They were legally obligated to produce it. They would produce it anyway at $40 margins, and they did produce it for 3 decades with no credits at all. What is the possible justification for an $8 per barrel production credit out of a field like Prudhoe? That's ridiculous.
Well, let's talk about the per barrel credits for a minute. When when SB 21 replaced ACEs, the tax rate was increased from 25 to 35%. If they had stopped there, it would have been a very high tax, but at the same time, they put in progressivity. But as I said before, but instead of increasing the tax rate as prices go up, it started at the high 35% rate and decreased tax rate as prices go down. And the mechanism to decrease the tax rate is the per barrel credit. It's a higher credit at low prices and a lower credit at high prices, and the result is progressivity. Again, I said, if your IRS tax rate was 20%, the way they get you there is first tax you at 35 and give you a credit to bring you down to 20. And so the per barrel credit and the higher 35% tax rate were engineered to give competitive tax rates. Give it, right now under SB 21, the state is getting this, as I mentioned before, the producers in the state are paying a higher percentage of their pre-tax profits to the government than they are in the lower 48. With that per barrel credit. And if you'd taken the trouble to model it, you would have seen that.
I did, and it doesn't.
Okay. All right. Okay, gentlemen, let's turn to audience questions at this point. So we have some questions that have been submitted. Again, in the chat feature, you can submit additional questions. Please, again, be brief in terms of wording your questions. So we'll try and balance this out, but there may be a slight challenge in that given the tendency of the audience at this point. But let me start with this. And this is posed to Mr. Brena. You have stated in the past and referred to today that the oil industry made promises that it would increase investment in production. Can you be specific about who, what, when, and where those claims were made?
I think that you go back and if you take a look at the actual producers, and they don't promise anything one way or the other, just like right now, they're not making promises that Ballot Measure One will impact one job or $1 of their future investment in Alaska at all. They just they have people that just magnify the fear that they're trying to create to keep us from getting a fair share. But those particular promises were promises that the voters acted on. You recall the governor coming forward with, let's get to 1 million barrels a day. BP's no decline after 96 or 99 or whatever it was. Just promises after promises after promises that if we give away our share, that production is going to go the other way. We did, and it didn't. And so if you go back, production and jobs, which let me say something, doesn't matter what the level of production is unless it brings in more jobs or more revenue for Alaska. And right now we're giving away the revenue and we're giving away the jobs, and the production's dropping anyway.
All right, thank you. We have a question that I think both of you can reflect on. Taxation can serve as an incentive or a disincentive for economic activity. If the production rate for smaller fields exceeds 40,000 barrels per day, they will be subject to higher taxes. And if so, how is this an incentive to increase oil production? Mr. Marks, you want to go first on that?
Well, this is sort of what I was talking about before. Right now, Hillcorp is doing a lot of work at Milne Point. And the terms of the initiative that puts you over the top into this higher tax is cumulative production of over 400 million and production of over 40,000 barrels a day. Well, Milne Point has had cumulative production somewhere around 380 million. Right now, they're producing about 30,000 barrels a day, and they've been looking at some developments that would put them over 40 and within a very short time put them over 400 million barrels a day. If this tax goes through, I cannot envision them at all going through with those developments. The increase in the tax as a result of of expanding the field would wipe out a huge portion of why they would do that in the first place.
All right, thank you for that. Mr. Brennan?
What all the studies actually indicate is that by and large, production activity, and particularly in legacy fields that are in harvest mode, are inelastic to increases in severance taxes. And so what that means is that, well, first let me clarify something. The Fair Share Act doesn't kick in until there's 400 million barrels produced from that field. To take Willow as an example, it's supposed to be 600 million barrels of 45 API gravity oil. That's light, sweet, beautiful crude oil. They're going to make a killing off of Willow. That's $50 a barrel. That's $30 billion. And it costs them $4 billion to get to first oil and $6 billion through complete development. So the ballot measure one doesn't even apply to Willow and won't apply to Willow until after they produce 400 million barrels, which is over $20 billion of revenue. So it isn't an incentive. But on the other hand, what you don't want to do is give incentives that don't incent any behavior. And when we're giving $750 million to Prudhoe Bay, the largest ticket item that we're talking about here, for producing oil that would have been produced anyway, because the margins at Prudhoe are the best margins in North America. It's the largest, most profitable conventional oil field in North America. And so every barrel of that would be produced anyway. What are we possibly giving away $750 million to a field that would produce the oil anyway and is under a legal duty to produce the field under the terms of their lease, and which is making a killing producing the oil? So you don't go out in Prudhoe in 2018 alone. We gave them $742 million of credits. Do you know how much they invested in Prudhoe? $202 million. We gave them 4 times more in a subsidy than they actually invested. Now that is just a waste of our resource. You don't go out, someone come and tell me, give me 4 times more than my investment as an incentive to do something. Are you kidding me? And this is what we're doing. And that is the largest single ticket item on the table. All this obscurity about the theories of taxes. We are giving away $750 million for Prudhoe Bay oil that would be produced anyway, and they're making a killing off it without the barrels. It reduced our taxes from $970 million out of Prudhoe down to $230. Rogers mentioned that 25% offsetting by the $8 per barrel. It drove, what that $8 per barrel does is drive the 25% rate that they went to 35, it drives the 35% rate down to the minimum. In Prudhoe Bay in 2018, the 4% minimum tax would have been $226 million. What we got from the net calculation because of that ridiculous credit was $230 million. So it drove the rate for Prudhoe Bay oil down to the 4% minimum for the most profitable field in North America. That's ridiculous.
Okay, thank you. All right, we have a question. Well, there's a lot of discussion about how the ballot measure, if enacted, would affect the investment climate. And I'm wondering if you could both reflect on that. There's a supposition that oil companies are making excessive profits in Alaska. But as we've seen, we've had major players such as BP leave, and you know, the replacements for such a player in Alaska Oil are operating under very different circumstances. So, and we don't see lots of new entrants into the marketplace at this time, especially given current circumstances. So can you both reflect on how you feel the ballot measure will impact the investment climate? Let's start with Mr. Marks.
Well, so last month, IHS Markit was here addressing Commonwealth North with their analysis of Ballot Measure One. They're run by Daniel Yergin. They're a very respected firm. They're beholden to no one. And this is one quote from their conclusions on Ballot Measure One. said Alaska has one of the most unstable oil and gas fiscal systems in the world, resulting in fiscal instability and loss of investor confidence in the state. Yeah, right now, the USGS says there are 4 billion barrels of economic recoverable undiscovered oil in the state. And there's basically two companies looking for them, two major companies looking for them. And it, frankly, Alaska has a lousy reputation, and this will just make it worse in terms of, instability. We talked about, the Willow and Pika fields. Mr. Brena said they wouldn't be impacted by this. I mean, if they should come online, it'd be 300,000 barrels a day and create thousands of jobs. But, those developers have to be thinking, if this passes, what is the risk of us spending $10 billion? And then there would be the next ballot initiative. After all, everything, they've been saying about fair share now would apply there too. So I think this would just make a bad investment climate worse.
All right, thank you. Mr. Brena?
Well, first of all, the instability in our tax system has been largely driven by the industry drilling in Juneau more than on the North Slope. They're the ones that are down there requesting breaks. We got this in this net system. They just go down there time after time after time and get more favorable tax treatment from our legislature. So they don't get to go down there and change the tax code every other year to their benefit and then complain when we try and take something back that, oh, it's too many changes. But secondly, the major challenge to the investment community in Alaska today is the massive state deficit, and because we are not even managing our own affairs properly. So if lowering our severance taxes were the answer, we've been at zero for 5 years under Senate Bill 21, and we haven't got a new explorer up here. Obviously, severance production taxes are not the answer, because we aren't getting anything and we're not getting any new players. So it's a more complex phenomena than, well, don't raise your taxes, you'll scare everybody off. We lower our taxes to nothing and nobody shows up. So obviously that's not working. Governor Hammond's suggestion was start at 99% and lower it until they start drilling. Don't sit here at zero and be intimidated out of raising our production taxes because something might happen. Okay, so first of all. Secondly, there simply is no empirical evidence supporting any conclusion that Ballot Measure One would have that impact. To be specific, Texas went from 12.5% royalties up to 25, much bigger increase than this. No impact to production, no impact to lease interest. Our sister states are getting 3 times more than we are, and they will continue to get more than we are after Ballot Measure One passes. No impact to that. We have had, before the pandemic, we had the highest unemployment rate in the union, and we were getting nothing in our production taxes. And North Dakota was getting combined 30%. We're getting production and royalties. We were getting combined 12.5%. They had the lowest unemployment rate in the world, in the United States. The reason for that is they keep more of the value of their oil within North Dakota, and we are dumb enough to let ours go to Texas.
All right, thank you.
So all of the evidence, there's 2 GAO studies that show that when you increase severance taxes, what happens is the taxing authority is better off and there's minimal to no impact to production. There isn't one bit of evidence to the contrary. So what I told Oil Search was when I met with them is, how does it get better for new explorers? We are taking the political risk out of doing business in Alaska through the Ballot Measure One, and by addressing the state deficit and not costing new and developing fields a penny.
Thank you, Mr. Brena. All right, we're going to have one final question. We have a couple of questions that have come in that are asking about how can you explain how the open records provisions of the ballot measure would work. And an additional question along those same lines is how the transparency portion of the bill would hurt the many contract companies that work with the oil companies. Can you speak to those? We'll start with Mr. Markson.
Well, Yeah, the open records or so-called transparency provision of the ballot measure is just one more piece of extremism, isn't it? It says in quite plain English that all tax filings and supporting information are public. It's very open-ended. It's as if your IRS tax return was put on the internet for everyone to read. And those of you who have your own businesses, think about the problems this creates. What happens when all your competitors and all your suppliers know what you're paying for supplies from each other's source? And what happens when all your competitors and all your customers know your sales terms to each other purchaser? And what happens when every West Coast refiner sees what each company is selling oil for to every other refiner, provides an opportunity for refiners to lowball the oil purchase price and undermine the value of Alaska oil? And not just the oil companies are affected by this. Anyone who buys or sells to the industry, their records become public too. And some local vendors are very nervous about this. So this is just another example of extremism in the initiative, which lacks any tempering influence.
All right, thank you, Mr. Marks. And Mr. Brena?
Well, none of that's true. There isn't any resource owner in the world that is in a net deal with a producer that they don't know how they got to the net, that the people making the calls didn't know how they got to net. So you think Norway and Saudi Arabia, who are in these net deals with these major producers, don't know what the revenues, costs, and profits are? That's just wrong. But let me just say what it says. What it says is that the tax filings and supporting schedules will be a matter of public record. Now, that doesn't have anything to do with their suppliers. That doesn't have anything to do with competitively sensitive terms among oil service providers, oil field servicers, or ballot. None of that stuff is on a tax return calculating the net calculation, and the supporting schedules don't have it. So it's not the intent and it's not the language, and we put into the legislature Senate Bill 129 that says exactly how it's supposed to work. And it just doesn't do that. That's just fear mongering and misinformation. So, but how can we be the stewards for hundreds of billions of dollars of oil resources in Alaska and be driving down the street blind without having any idea at all how our actual fields are doing? We're in a situation right now where our tax oil policies aren't being driven by specific facts, but massive misinformation campaign, of which Mr. Marks is part of, that puts $25 million of misinformation out to Alaskans. After the Fair Share Act, we will know exactly what the major producers in our three major fields, what their revenues, costs, and profits are for each field. Because I, for one, as an Alaskan, am sick of all their whining about not making enough in Alaska when they're sitting here hiding how much they're making from us.
All right, thank you. Thank you. All right. All right, now we're going to conclude with closing remarks from each of our speakers. But as we do that, I'm going to launch the post-forum poll, so you can begin voting for that. We will turn to closing arguments and closing statements, and we'll start with Mr. Brena, please.
Okay. Alaska's still broke at the end of our conversation as it was before. I didn't hear a plan from Mr. Marks about how to address the issue. I notice I don't get to vote this time, but I'm still a yes vote, by the way. So for one, but this is serious times. We're not asking for an unreasonable, we're asking for part of what they took from us, which is through Senate Bill 21. We're not even asking for it all back. We're asking for less than our average. It's reasonable to the industry, and keeping another $1 billion in Alaska is going to help Alaska. And before we go too far down this poor oil company event, you need to take a look at what they're actually doing with what they're making up here. Okay, ConocoPhillips just within the last week just announced $1 billion buyback of their stock, and a $10 billion distressed property purchase because their balance sheet allows them to, because they've been making all this money off us. Over the last, they have increased their dividends by 60% in the last 2 years. They have paid down $12 billion of their debt, while we have gone through $18 billion of our savings. And they have, 3 months ago, they authorized an increase to their stock repurchase program from $15 billion to $25 billion. And since Senate Bill 21, they've spent billions of dollars repurchasing their stock. So just out of the gate here, we're in a situation where this doesn't work for us. We're being driven into the poorhouse. We've exhausted all our savings trying to make Senate Bill 21 work. We gave it a shot. Alaska doesn't work if we don't have a fair production tax system. And we've proven that to ourselves by being in a recession with no capital budget and declining production and declining jobs ever since Senate Bill 21 passed. We need to do something better than that. We need to come up with a suggestion. And the only solution that's reasonable, this is a common sense solution. It eliminates the credits from these major fields that should have never been given, that were thrown in at the last hour on some legislation that wasn't even studied. And it's costing us $1 billion a year of our money. So we're just trying to get that back, stabilize our political and investing climate in Alaska, and keep $1 billion more in Alaska rather than going to ConocoPhillips and BP and Hillcorp shareholders and owners. And if it is a reasonable first step in addressing the state deficit, and if after we take it, it'll help funding PFDs, it'll help funding essential government services, it'll help funding capital budgets, it'll save and create the equivalent of 11,000 jobs in Alaska at $100,000 a year over time. So what are the choices? It's reasonable, it's moderate, it's simple, and it's what we need. And I don't hear any solution other than to start taxing Alaskans for the oil we're giving away. And that's ridiculous.
Thank you. All right, Mr. Marks, 3 minutes.
Sure. Getting back to the IHS presentation last month, I just want to quote three findings that they had. Number one, most jurisdictions improve fiscal terms since the 2014 oil price crash. 2, Alaska's current fiscal system is one of the least competitive ones within the US and international peer groups. Relatively higher unit costs contribute to lower project profitability. And 3, under Ballot Measure One, Alaska's ranking erodes further. And just to do some sweeping here, Mr. Brena said we're going to get $1.1 billion from this. That's at $75 oil. Nobody thinks oil is going to be $75 for a long time. He mentioned a multiplier effect of 6 to 7. Nothing in economics has ever had a multiplier effect of 6 to 7. He mentioned Prudhoe is the most profitable field in North America. He's comparing Prudhoe profits with diluted oil and gas profits in the lower 48. Back in 1962, the state could have started its own state-owned oil company, but instead it opened up the North Slope to the experience, expertise, and capital of multinational corporations through the competitive bidding process. And the North Slope was developed subject to market forces. I don't think the state would have had the stomach to go through the 10 dry holes that it took to discover Prudhoe Bay. So it's essential to be competitive to attract investment. And as I always say, capital is finite and fluid. It goes to where it gets the best deal. The standard of getting 1/3 of gross revenues as a standard for fair is absurd. And if you do the modeling, you would see that's what happens under Ballot Measure One. Something cannot be fair to just one side. Unless it's fair to both sides, it's not fair. We have tried the experiment of not being competitive more than once. We've tried to experiment more than once and it failed. Thank you.
All right, thank you. All right, gentlemen, thank you both for your time today. Again, we do have the poll open. A few folks have not voted, but while we're waiting for those final votes to come in, let me just remind folks that we do have an event coming up on November 12th, which is the Hickel and Egan Awards. This year we'll be honoring the late Jacob Adams, Oliver Levitt, and Tara Sweeney. So please join us for that event. We'll be opening up individual ticket sales soon, and we're currently accepting sponsorships. So if you have any questions about that, please contact me or Aaron Weddle at Commonwealth North. And with that, let me turn again to a thank you to Roger Marks and Robin Brena for being here today. We certainly believe in civil discourse and talking about Alaska's critical issues. So we thank you for helping us with that effort on this particular issue. Again, for reminders for everyone, early voting, early in-person voting is now open at polling locations across Alaska. We encourage you to vote. And if not now, certainly on November 3rd. And with that, let me end our polling.
Can I figure out how to vote? I voted before.
Oh, well,
but not afterwards.
I apologize. I'm not sure why you didn't see it, but I just ended it. Let me just share the results as they exist now. And so we had, again, we've had some shifting in terms of the people participating. So not everybody that voted in the first poll is voting here. But again, the numbers were fairly weighted towards the no on ballot measure one message with 77%. Roughly, let's call it 21 or 22% with Robin's vote totaled in there for yes, and still at least one person undecided. So perhaps one of you has maybe moved them in one direction or another. And maybe it's also an indication that folks continue to need to hear a little bit more about this topic. With that, let me thank everybody for your participation, again, to our speakers, and hope to see you soon at another Commonwealth North event. Thank you so much.
Thank you.